Hey everyone, welcome back to Boni's Life. I'm your host Boni, and if you're watching this on August 29th, 2025, you're probably wondering why your crypto portfolio looks like it went through a blender this week. Don't worry, I've got you covered with a deep dive into what's really happening in the markets. Today we're dissecting the past 7 days of crypto chaos, and trust me, there's more going on beneath the surface than meets the eye. We're talking Federal Reserve drama, institutional money flows that would make your head spin, and some technical patterns that have me both excited and cautious at the same time. Before we dive in, if you're new here, this channel is all about making sense of the financial world without the Wall Street jargon that makes your brain hurt. Hit that subscribe button and ring the notification bell because we're about to unpack some serious market intelligence that could save your portfolio. Let's start with the elephant in the room. The crypto market just shed nearly $300 billion in market cap, dropping from over $4 trillion to $3.88 trillion. That's like watching the entire GDP of South Korea vanish in a week. But here's the thing that most people are missing. This isn't the apocalypse scenario that social media is painting. Bitcoin is sitting at $110,125 as I record this, down about 7.6% from last Friday. Ethereum took an even bigger hit, falling 5.2% in just the last 24 hours to $4,376. Now, before you start panic selling your grandmother's jewelry to buy the dip, let me put this in perspective. We're still talking about Bitcoin being 11% away from its all-time high. In traditional markets, that's called a healthy correction. In crypto, apparently, it's the end of civilization as we know it. The fear and greed index is sitting at a perfectly neutral 47, which tells me that despite all the red candles, smart money isn't panicking. Here's what's really interesting. While retail traders are freaking out on Twitter, institutional money is doing something completely different. Bitcoin ETFs just had their 4th consecutive day of inflows, pulling in $178.9 million on Wednesday alone. Ethereum ETFs? They're on a 6-day winning streak with $39.16 million in fresh institutional money. Now let's get into the technical meat and potatoes because the charts are telling us a story that's way more nuanced than number go down, world end. Starting with Bitcoin, we're looking at a textbook bearish MACD crossover across all major timeframes. The RSI is sitting at 36.3, which is neutral territory but trending lower. What's got my attention is the volume profile. We're seeing increased selling pressure, but it's not the capitulation volume you'd expect in a major crash. The key levels I'm watching are crystal clear. Bitcoin needs to hold $107,000 as immediate support. If that breaks, we're looking at a potential test of the psychological $100,000 level. On the upside, $114,000 is the line in the sand. Bitcoin tried to break above it twice this week and got rejected both times. Here's where it gets interesting from a Fibonacci perspective. We are currently sitting right at the 38.2% retracement level from the recent swing low to high. If this is just a healthy correction in an ongoing bull market, this is exactly where you'd expect to find support. Ethereum is painting a different picture entirely. Despite the recent pullback, ETH is still showing relative strength. The weekly chart is still green by 0.3%, and we just saw a new all-time high at $4,960 earlier this week. The institutional narrative around Ethereum is completely different from Bitcoin right now. The technical setup on Ethereum is actually quite bullish if you zoom out. We're seeing what analysts are calling a megaphone pattern that could target $10,000 in the longer term. I know that sounds crazy, but when you look at the institutional adoption rate and the ecosystem growth, it's not as far-fetched as it seems. Let's talk about what's really driving these markets, because technical analysis only tells half the story. The fundamental landscape has shifted dramatically in the past week, and most people are completely missing the bigger picture. The Federal Reserve just dropped a bombshell that nobody's talking about enough. Governor Christopher Waller came out on Thursday and basically said, "We're cutting rates in September and we're not stopping there." The market is pricing in an 87.2% probability of a 25 basis point cut next month, with additional cuts expected over the next 3 to 6 months. Now, here's why this matters for crypto. When the Fed cuts rates, it makes holding cash less attractive and pushes institutional money into risk assets. We're already seeing this play out in the ETF flows. BlackRock alone pulled in $63.72 million for their Bitcoin ETF on Wednesday, and their Ethereum ETF is absolutely crushing it with $67.62 million in inflows. But there's a catch, and this is where the market gets interesting. The Fed is walking a tightrope between supporting the labor market and not reigniting inflation. If core inflation starts ticking up again, those rate cuts could get delayed, and that would be a major headwind for risk assets, including crypto. The regulatory environment is also shifting in ways that most people aren't paying attention to. The CFTC just launched what they're calling a crypto sprint initiative, which is basically regulatory fast-tracking for cryptocurrency businesses. They are also providing new guidance that could allow foreign crypto exchanges to re-enter the US market. This is huge for liquidity and competition. When Binance was essentially forced out of the US market, it created a liquidity vacuum that domestic exchanges filled at higher spreads. If foreign exchanges can come back, that's going to compress spreads and increase market efficiency. Now let's talk about the global events that have been moving these markets, because crypto doesn't exist in a vacuum, despite what some maximalists want you to believe. The biggest story that's flying under the radar is what happened at the Bitcoin Asia 2025 conference in Hong Kong. High-profile speakers started withdrawing from the event because of political sensitivities around having Eric Trump as a keynote speaker. This might sound like inside baseball, but it's actually a perfect microcosm of the geopolitical tensions that are shaping crypto markets. China's continued crypto bans, India's central bank digital currency ambitions, and the US regulatory uncertainty are creating what economists call fragmented liquidity pools. When markets are fragmented, you get increased volatility and reduced efficiency. That's exactly what we're seeing play out in real time. The other major factor is what I call whale psychology. We had a massive $2.7 billion Bitcoin liquidation from a dormant whale address that triggered what analysts are calling a flash crash. This isn't just about the selling pressure, it's about how the market structure has evolved. And in the early days of crypto, whale movements would create massive price swings because there wasn't enough institutional infrastructure to absorb the shock. Now we have ETFs, corporate treasuries, and sophisticated trading desks that can step in. The fact that Bitcoin only dropped 7.6% after a $2.7 billion sell order shows you how much the market has matured. But here's the psychological component that's really interesting. Retail traders saw the whale movement and panicked, creating $1.8 billion in liquidations across the market. 74% of those liquidations were long positions, which tells you that retail was still heavily leveraged to the upside when this correction started. I want to share some insights from the smartest people in the room, because when markets get volatile, it's crucial to listen to voices that have been through multiple cycles. James Toledano from Unity Wallet made a point that really resonated with me. He said Ethereum has stolen the spotlight, and the data backs this up completely. While Bitcoin is struggling with technical resistance, Ethereum is seeing massive institutional adoption. Hedge funds and corporate treasuries are accumulating ETH at rates we've never seen before. But Toledano also issued a warning that I think is spot on. He said, "History cautions toward late summer September pullbacks even after sharp rallies. This isn't just crypto. Traditional markets have shown this pattern for decades." August and September are historically weak months for risk assets. Jia Haosun from Flock.io had an interesting take on the current correction. He called it a natural market correction following significant gains and emphasized that we're seeing a maturing and dynamic asset class. I think he's right. The fact that we're having an orderly correction instead of a complete meltdown shows institutional maturity. What's really fascinating is the shift in narrative around altcoins. Sun pointed out that both retail and institutional investors are seeing the unique utility that altcoins provide over Bitcoin. This is a fundamental shift from the Bitcoin-only narrative that dominated the last cycle. All right, let's get practical. What does all this analysis mean for your trading strategy over the next 24 to 48 hours? For Bitcoin, I'm cautiously bearish in the short term. The technical setup suggests a 65% probability that we test the $107,000 support level in the next day or two. If that level holds, we could see a bounce back toward $114,000. If it breaks, $100,000 becomes the next major battleground. My strategy for Bitcoin is simple. Wait for a clear break above $114,000 before adding to long positions, or wait for a successful test of $107,000 support for a potential bounce play. The risk-reward isn't compelling enough in the current range to make aggressive moves. Ethereum is a different story entirely. Despite the recent pullback, the fundamental picture is incredibly strong. I'm giving ETH a 55% probability of retesting the 4,500 to 4,600 resistance zone in the next 48 hours. The institutional flows are just too strong to ignore. For Ethereum, I'm looking for any dip toward $4,300 as a potential buying opportunity, with a target back toward $5,000. The risk here is if Bitcoin breaks down significantly, it could drag everything with it. But ETH has shown remarkable relative strength. For the altcoin space, we're seeing some interesting opportunities. XRP is showing unusual volume spikes, up 51.6% in trading volume, which often precedes significant price moves. ADA got absolutely hammered, down 8.44% over the week, which might present a contrarian opportunity if you believe in the long-term Cardano thesis. Here's my bottom line take on where we stand. The crypto market is going through what I call institutional growing pains. We are transitioning from a purely speculative asset class to something that pension funds and corporate treasuries actually want to own. This transition isn't going to be smooth. We're going to see periods of volatility as different types of investors with different time horizons and risk tolerances interact in the same market. But the underlying trend is clear. Institutional adoption is accelerating. Regulatory clarity is improving, and the macroeconomic environment is becoming more favorable. The Federal Reserve is about to start cutting rates, which historically has been rocket fuel for risk assets. The question isn't whether crypto goes higher from here, it's how fast and how far. My advice: stay informed, manage your risk, and don't let short-term volatility shake you out of long-term positions. The market is giving us a masterclass in patience right now. That's a wrap on today's analysis. If this helped you understand what's really happening in the markets, smash that like button, subscribe for more market intelligence, and drop a comment letting me know what you want to see analyzed next. Remember, in crypto, fortune favors the prepared mind. Until next time, this is Boni, and I'll see you in the next episode of Boni's Life.